Your decisions you make today are dictating where you're going to be. So fix the plan now and get the plan on track.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
So we're going to talk about market volatility and the fear that the media is creating in everybody, that recession fears are coming. And I want you to stop and think for a second. How old are you? How long have you been here? How much news do we have? And why does the news create fabulous headlines? Because they want you to listen. They want you to watch. Why do they want you to watch? Because their advertisers are paying good money for your eyeballs. And who are the advertisers that are on the shows that you're watching? Who is it? Soap? Financial institutions? That goes back to exactly what we've been talking about over my entire 35-year career, which is the 5 rules of the financial institutions. They got to make you feel good to put money into their investments. So they're advertising, right? But they also need the eyeballs to come to pay for the media stations that are out here now, right? If the media stations don't have really good advertisement, they don't have people that are talking about what they invest in, right? So it's like this whole big thing. I'm not saying it's bad or good or whatever it is. I mean, nobody's advertising on my thing at this moment, and maybe after they listen to this, they won't want to advertise, right? That's fine. What I want to talk about, though, is we're in the middle of a market correction. Maybe when you're listening to this, we're not in the middle of a market correction, but it's the same thing that I want you to get. So we're going to talk about consumer sentiment, and we're going to talk about behavioral science of how people deal with emotions as markets go through their periods, okay? So I'm not going to start with the chart that's on my screen. I'm going to switch to a different chart. Russell Investments put this out. This is a really good chart. This is not Russell's investment. They put the chart out. This chart's been around for 35 years in different variations and different things that I've been in the industry. It might be here even longer, okay? I don't know who originated it, but I pulled this from Russell Investments. Russell Investments is not investing, not advertising on the podcast. And I actually don't have any holdings in Russell, okay? I just love the chart. So the chart is the cycle of human emotion, okay? When you're investing on the left-hand side, you begin with optimism. Market moves up. You move into what we're going to call excitement. Then it's like, oh my God, the thrill. I bought something for $10 and it's $50. I bought Bitcoin at 20,000. It's now 70,000 or 50,000 or whatever it is, right? And now it's unbelievably profitable. And I have what's now called euphoria. I am brilliant, which is at the point of the maximum market. When the markets get high, we get phone calls, put all my money in. I'm like, why? You didn't have your money in all in before. Why would you have all your money in now? When it's at the highest level, because the market's doing great. The market did great. It's not necessarily doing great in the future. Okay? What happens now, the market hits a little bit of a speed bump and we get into denial. And that speed bump declines further. And I get into, anxiety. I'm afraid I'm going to run out of money. Fear, depression. I should have sold. I should have sold when the market's at the top. Now it's like, oh shit, I need to cover my losses. I need to go to cash. You get this complete despondency, and it's the point of maximum financial opportunity, according to this Russell chart. And then the market moves up, and you're skeptic. I'm going to maybe I'll put a little bit more money in. Bottom of 2009, after a 57% correction, I don't want to invest in anything because the world's going to go bankrupt because the headlines are forcing me out of the market. It does a little better. I've got hope. I'm back up to where I was with relief, And now I enter the optimism cycle all over again. Now, this is something, there's a study called Dalbar, D-A-L-B-A-R. Dalbar Associates, I believe it's a nonprofit consumer think tank. I could be wrong. I've been known to be wrong, okay? And I admit that. And the Dalbar study says, market did this over a 20-year period, average mutual fund did this, and the average investor did this. And the reality is the market did this, the average mutual fund did less, and the average investor did a lot less. Why? Just because of this chart. They're selling at the wrong times. So when you start to think about this, if you're falling into this, and I'm not saying you should sell, I'm not saying you should buy, I'm not saying you should react, I'm not saying anything, but you need to understand that this, if you're driving your wealth from an emotional perspective, reading the tea leaves of past performance, because now we're getting a whole bunch of earnings reports that didn't meet expectations and stocks are dropping. Things are on sale. Opportunity. Not, oh shit, I need to sell. Okay? So JP Morgan puts out a really wonderful chart with great data. This goes back to 1971, almost my entire lifetime. I was born in 68 because I'm 56. So this really gets a lot of data, right? And the chart is basically saying consumer sentiment index. How does the investor feel in that market? How are they? Where are they? Are they in the despondency? Are they in skepticism? Are they in anxiety? Are they in excitement? And how does the market do 12 months later? This is really powerful. Like, you got to come to the YouTube channel and effing watch this, okay? Because this goes on every single year that I've been doing this for 35 years. We're not financial. I joke. I wish that I had a finance degree. I wish I had a minor in finance and a major in psychology. I really do. Okay? But the reality is here. When the consumer sentiment is high, 12 months later, here in 1972, the market's down 6.2. When the consumer sentiment is low, because the market's down, I think the market's down at that point 42%, not year by year, but over a 12-month period, the market's down massive in here. The market's up 22%. So when people have capitulated and said, shit, I'm out, that's exactly when you want to buy. I think it's Peter Lynch, one of the greatest investors of all time, said you got to buy when there's blood in the streets, even when it's yours. Okay? 1980. May 1980. And by the way, there are gray lines in here. Gray lines are recessions. The gray lines are recessions. All right? So 1980, we're in a recession. Market's up 20%. Through the recession, market was bumpy in here. Now the market's high, 1984. Interest rates are freaking through the roof, by the way. It's 17% CDs, right? Market's up 13.5%. Now you have the 1987 correction. We had a recession into the early 90s, right? I graduated Bentley College, which is now university, in 1990. It was a recession in the early 90s. And everybody was despondent. 12 months later, the market was up 29%. January 2000, after the biggest uptick. And now, there was a big, right here, in this downturn in 97 was the Asian contagion. Market was down 27%. Bounced back quickly, because I was over there. It wasn't over here, okay? And the market was down 2% after that. And then we hit a bottom because we went through another recession, and the market bottomed, and then the market was up 32%. And then when the consumer sentiment's high, it's down 4. And I'm going in minutia because here we are in the 07, 08, and here's the market bottoming in November of 2008. It bottoms again in March. And 12 months later, the market's up 22%. And then you get that 2011, which was, I forget what it was. It's down again. It's up 15%. And then it's, 2015, everybody's feeling good. And then it goes sideways and it's down 2.7 because everybody's feeling good. The tea leaves look fantastic. Let's buy. And the market doesn't do anything. These are the points below the line when things are ugly. We need to buy. But I need my plan to support this. I need a certain amount of cash. I need defensive assets, right? I see really bad advice. Why are you sitting on all that cash? You don't need that cash. You should put that money to work because you're missing that 27% rate of return that just happened in the market. And people plow their money into the market and they violate their cash reserve rules. And then when the market tanks, they need money for that opportunity that they wanted to do, the kitchen renovation, the housing addition that they want to put on, the country club that you want to do, the college plan that you're going to send your kid, and now you got debt because it was the wrong reasons. The rules need to be in place for the investment so that when market volatility happens, you have the capacity to buy when blood is in the streets, when it's your own, right? And that if I'm looking at past information to make my future predictions based on a cluster of beliefs that are not necessarily correct because nobody knows what's going to happen. Nobody knew that Enron and Lucent were going to have accounting issues and go out of business, right? There are principles that say single stock concentration, I should reposition my assets systematically over a long period of time. It's not about getting rich, it's about staying rich. One of my favorite conversations in my career, right? There's a point where you take profit. There's a point where you reposition. There's a point where you do this on an ongoing basis without emotion. And that's what you need to think about. And when you're investing, if I have a solid foundation, I have principles and rules and how I'm buying and what my risk metrics are, I systematically buy. And when markets are down and I'm in retirement, I have a backstop to go after. I have a volatility buffer behind me to protect me in the down market. That is the power of what we're doing in the plan. If I understand that, then I can capitalize on the opportunities. When everybody's selling, that's when I should be buying. But guess what? I'm going to be buying when the market's up also because I have a systematic plan. I make money, I invest it. It was either a good day or a bad day. In hindsight, I only know that. And I can't hold myself accountable for making a decision in the moment back there based on my principles. I know this. If I systematically put money away, I actually buy in up markets and I buy in down markets and I buy in sideways markets. But if I systematically do it for a long period of time, I pay myself first and spend after, and I base my spending on last year's income, assuming I can replicate that income into the future, now I'm in control of my plan. And I don't arbitrarily retire because I'm tired and give up a fabulous paycheck before I have the accumulated wealth that I need to sustain my lifestyle. And this is what I'm seeing is people are like, I got to get the freak out. I got to get out. To what? You don't have enough capital. If you're 55 years old and you're listening to this and you make $300,000 a year and you don't have $2 million saved now and you're not on track to get to 4 or 5 million, you don't have enough money to sustain a long-term retirement plan. Now, the question is, how long am I going to live? Am I going to live to 120? Am I going to live to 100? Am I going to live to 85? Am I going to live to 56.9? Unfortunately, I don't get to control all the outcomes. But I got to build a plan as if I'm going to 120 because I don't want to get to 100 and be out of money. I don't want to get to 85 and be out of money. How many plans are running right now that people are going to run out of money by 75 or 80? And they're going to live to 85, 90 in misery. Is that you? Or do you want to get a plan? You're going to end up somewhere 15 years from now. 15 years from now, you're going to arrive. The question is, did you arrive where you want to be? And are you living the way you want to live? And do you have the wealth that you want to have? 15 years goes incredibly fast. Your decisions you make today are dictating where you're going to be. So fix the plan now and get the plan on track. Invest in your financial future and don't worry about the noise. Stick to your plan, stay positioned, don't chase returns, don't be the emotional roller coaster. Be the person who sticks to the plan and modifies it based upon results, changing risk, because risk changes. Risk, when you run risk metrics, the risk is different every single day, right? The risk in the economy, the risk in all things, global, geopolitical, all these things, black swan events are constantly pushing at us, right? Am I protected? My job has risk. Everything has risk. How do I maximize that risk and minimize the downside? How do I pay the least amount of taxes and have the maximum amount of income in retirement? How do I protect my wealth from a maximum perspective that regardless of whether I go into a long-term care facility or I die prematurely or I die with a big estate and have massive estate taxes, that I transfer my wealth to the people that I want to, not to the corporations and the government that's coming after it. You are in control of your outcome. The question is, are you actually taking the steps to do it? Love you guys. Thank you for listening. Give me feedback.